Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the complex world of corporate finance. And today we're diving into a fascinating filing from the abrdn Global Dynamic Dividend Fund. You know how some companies try to look really fancy with big words? Well, we're going to unpack what all that actually means for your money if you're even thinking about investing. And before we start, if you love getting straight to the point insights from these financial documents, hit that subscribe button. We also have a Discord community linked in the description below where we break down these reports even further. So come join the conversation there. So what is this abrdn Global Dynamic Dividend Fund all about? Essentially, it is a company that invests your money with the goal of giving you regular income through dividends. They're looking for companies that pay out a good chunk of their profits to shareholders. It is not just about dividends though, they also want the companies they invest in to grow in value over time. Think of it as a two-pronged approach to getting you some returns. This filing is a registration statement, which is basically a company telling the world they want to sell more shares and laying out all the details about what they do and the risks involved. For investor funds like this, it is a pretty standard process, but the devil, as always, is in the details. When you invest, you want to know where your money is going. This section is like a fee breakdown. For every dollar you invest, some of it goes to fees. Right now, they're re-showing about 1.35% of your money goes towards annual expenses. That might not sound like much, but over time, it really adds up. The biggest chunk of that is for the advisory fee, which is 1%. That is the money paid to the people managing the fund, S Investments. Then there are other expenses like interest on borrowings, which is currently very small at 0.09%. Let S put that into perspective. If you invested $1,000, you'd pay around $14 in the first year in fees. Over 10 years without any growth or just a steady 5% return, those fees would add up to about $162. That is like losing more than a sixth of your potential gains just to fees within a decade. It's super important to keep an eye on those expense ratios. So this fund has been around since 2006 and it is traded on the New York Stock Exchange under the symbol AGD. Currently, the price of a share is about $13.75, but its actual value, what they call net asset value or NAV, is a bit lower at $11.75. That means shares are trading at a premium, a bit more expensive than what the underlying investments are worth. Sometimes this happens, but it is always worth noting. They're aiming for high current dividend income, with over half of it qualifying for a special lower tax rate. That is a pretty sweet deal if you're a dividend investor looking for tax efficiency. Their secondary goal is long-term capital growth, meaning they want the value of their investments to go up too. Under normal conditions, they invest at least 80% of their money in stocks of companies, both in the US and abroad. That pay dividends, they aim to hold stocks from about 10 to 30 different countries. Basically, they're not putting all their eggs in one basket geographically or by company. They also use a strategy called dividend capture, where they might sell a stock shortly after its X dividend date to try and collect more dividend payments over time. It sounds a bit like a trading strategy which can bring its own set of risks. They invest in common stocks, which are the usual shares of companies, but also preferred stocks, which are a bit like a mix between stocks and bonds. They also invest in foreign securities, which comes with currency risks and political risks. And they might dip into emerging market securities, which can offer higher growth, but also come with much higher risks. They do have a limit on how much they invest in emerging markets though, keeping it to 25% of their assets. Now, this is where things can get interesting and potentially risky. They can borrow money to invest more. They currently aim to limit borrowing to about 10% of their total assets, but they could potentially borrow up to a third of their assets. Borrowing to invest is called leverage, and it can amplify both gains and losses. If their investments do well, borrowing can boost returns, but if they do poorly, those losses can also be much bigger. They mentioned they might use leverage more or less depending on market conditions, which is a smart move, but it still adds a layer of complexity and risk. Let's take a look at their financial performance. In the 6-month period ending April 2025, the net asset value, or the actual value of each share, started at $11.15. The fund saw a small gain of 0.07 per S-share from its investments during that period. By the end of April 2025, the net asset value per share had dipped slightly to $10.55. Interestingly, the market price of the share at the end of that period was $9.99, which is below the net asset value. This means it was trading at a discount to its actual worth. Looking at the net asset value, it returned about 1.08% for that 6-month period. Now, let S jump back to their full fiscal year ending October 2024. There, the market price was $10.16, and the total investment return based on market price was a whopping 32.5%. 6.91%. That is a significant jump, and it shows how market sentiment can really drive stock prices, sometimes even above or below the underlying value. This table shows the fund S borrowings in April 2025. They had about $18 million outstanding on their credit facility. Their asset coverage ratio, which measures how much assets they have compared to their debt, was pretty healthy at over 1,500%. So, on the debt front, they seem well covered. Here, they discuss how their common shares trade on the New York Stock Exchange. They mention that shares can trade at a discount or premium to their net asset value. As of October 2025, the NAV was $11.75 and the market price was $13.75, a premium of about 17%. This suggests the market is optimistic about the fund, but it also means you'd be paying a bit extra for that optimism. This is a neat feature for investors. It means you can choose to automatically reinvest your dividends back into buying more shares of the fund, compounding your investment. There are some small fees for certain transactions, like 2 cents per share for open market purchases, but it is designed to make reinvesting easy. This section is about how they can sell their shares. They can do it directly through agents or via underwriters. Basically, it's outlining the different ways they can raise money by selling more shares to the public. This is standard legal stuff, but it basically says that if things go wrong, the shareholders, trustees, and officers are generally protected from personal liability for the fund's debts. The fund's assets are what will be used to cover any liabilities, not the personal assets of those running it, unless there is clear bad faith or gross negligence involved. As of the filing date, there are no major legal battles ongoing for the fund or its advisors. That is usually a good sign, meaning no big unexpected costs or disruptions are on the horizon from lawsuits. Now, let's talk about what this all means. The abrdn Global Dynamic Dividend Fund seems to be managed with a clear strategy: generate income through dividends while also seeking growth. They're spreading their investments geographically and across different types of companies. The use of only a small amount of leverage right now with a stated intention to use it cautiously is a positive sign for risk management. However, remember that premium to NAV. It means investors are currently valuing the fund a bit higher than its underlying assets, which could be a sign of strong investor confidence, or maybe just a bit of market froth. The expense ratio, while not the highest, is something to always keep an eye on, as those fees can eat into your returns over the long haul. The dividend capture strategy is interesting, potentially boosting income, but it also implies more active trading, which means more transaction costs and a need for diligent management to avoid short-term risks. Overall, this fund targets income-focused investors who are also looking for some growth, and it offers diversification. The key risks to monitor are the market's perception of the fund's value reflected in the premium to NAV, the impact of fees over time, and the inherent risks of international and emerging market investments. Alright, that is our breakdown of the abrdn Global Dynamic Dividend Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Are you a fan of dividend-focused funds? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives like this. Don't forget to check out the Discord in the description for even more insights and to connect with other investors. Thanks for watching. See you next time.